Hello, today is December 2nd, and we are following up on the video we posted yesterday. We got a lot of questions about that video. This was what we're calling an implied volatility sort of slingshot. And what that basically means is that as the market pulls back and implied volatility gets jacked up or raised up, that implied volatility will ultimately release, and that will fuel a rally into the end of the year. This would be called kind of a Vanna trade. And so we wanted to give an update on that, obviously, due to the market drawdown yesterday. There was this big reversal from 46.50 all the way down to 4,500. And around 345, we hit the 45.50 area, which we denoted as support yesterday. And then in the last 10 or 15 minutes, there was just this liquidation. And these liquidations, there was a MOC order that was $8 billion, and there's probably a lot of hedge adjustments that had to take place. So yes, our initial support level was breached here at 45.50, but this was in the last, again, 10 to 15 minutes, there was this giant liquidation, and then we kind of immediately regained that area this morning. Now, it's important to note that the debt ceiling appears to have been kicked down the road to February. So that is one unknown that likely helps implied volatility come down. And we're going to show some implied volatility metrics in a second. But what we really wanted to talk about, again, was our key support levels. So on these screens, you see some bars, large gamma, combo, etc. Now, these are support and resistance lines. If you look at our report for today, you can see that generally what we do in the very first sentence is say, how much do we think the market's going to move today, i.e. what's volatility? So for today, we're looking for a maximum open to close move of 1.2%. And then supports at 4,500, first resistance 45.62, and then we could get kind of an extended rally up into the 4,600 area. So if we kind of flip back to this chart, you can see here's the 4,500 line. We opened just above that, and we got a rally right up to just over 45.62. Right now the market has pushed just beyond that, but this was our first resistance line. And then based on our estimated move, we would think a max move for the day would be around 45.80. That would be a pretty strong rally. Now, what's key for markets, for bulls, is they need to regain this 4,600 area. And that is because at 4,600 is where we see the market flipping from a negative gamma position to positive gamma. So what do we mean by that? Well, again, if you flip back to our note, you can see that we have this idea called the gamma index. You can also look at it as GEX, or the notional gamma. And what this is telling us essentially is how much hedging do dealers have to do, and what's the direction of that hedging? So if it's a negative number, that means that dealers will hedge in the direction of the market. So if the stock market is going down, dealers will sell futures, and if the market goes up, they will have to buy futures, and that expands volatility, as you can imagine. If you sort of have a car going downhill and someone comes and pushes it, the car is going to go faster down the hill, right? Now, if this gamma index, or the notional gamma, flips back to a positive number, that is telling us that dealers are going to hedge into the market. So as the market goes up, they're going to sell, but if the market starts to decline, they will buy futures back, and that compresses volatility. It starts to tighten down the range, and that is the type of market you get kind of the inevitable kind of grind higher of the S&P. It draws risk assets out back into the market, and people are more comfortable because there's less volatility. So that number, this gamma number, doesn't flip from a negative number to a positive until 4,600. You can look at it another way. This is what we call our gamma combo strike profile, and this is the total gamma of the S&P broken down by strike. And if the bar is to the right, it's a positive gamma line, and if the bar is to the left, it's a negative gamma line. So what you can see here is that there's a lot of negative gamma at 4,500 and up through 45.50, and then it flips. You can see these positive gamma bars start ticking up over 4,600. What this is really telling you is there's a bunch of calls up here, there's a bunch of puts down here, and if we can kind of get over 4,600, we'll get into call positive gamma territory, and that will really help to support markets. It'll bring volatility down, and we think that's what gives the market kind of a lift. Now, let's just talk briefly about implied volatility, because that is really what the most important metric is for today. We started off the day with the VIX in a what's called backwardated position, which simply means that the VIX index, which opened just over 30, the blue line is yesterday, and so the VIX, if you were to plot it, would be up around 30. And since the VIX index is higher than the equivalent futures prices out in time, this is a backwardated curve. What that basically means is that we're in a crash scenario. The market crashed yesterday. That's not necessarily news to anybody, but what we do want to note is that if you look at today's metric, you can see that the curve has now flipped. In other words, this blue line has decompressed. And now we're kind of shifting back to a what we call contango. Now the VIX index itself is currently around 28, so that has to come down a little bit more. But as this curve declines, as this curve decompresses, that's an indication that options values, particularly puts, are losing their value. And so what that essentially means is market makers can buy back short hedges. Think about it. If you're a market maker and you're short a put, and that put is increasing in value, you need to short more shares to keep yourself hedged, right? Well, once that put starts to lose value, then you can buy those futures back or buy those shares back that you were using to hedge. And that can be a lift or a catalyst for a rally. So you can see at the moment this is taking place. We still hold this as the default area. Yes, there was a breach of our key support level for 15 minutes sort of into the close, and then we rallied back right on the open. We think this is just kind of an end of day liquidation tied to basically big MOC orders. So at the moment, everything is really going according to plan. This actually, again, this high implied volatility we think is a fuel for a catalyst higher. And until we break the 4,500 level, we favor this idea of a Christmas rally. We hope this video is helpful. If you have any questions, please send us a note at info@spotgamma.com. If you head over to spotgamma.com, you can get a free 7-day trial of our daily subscription service, as well as access to our equity hub, which allows you to look at the options position in over 3,000 different stocks.